Okay, Janet, let's right now, as we cover the entire presentation, again, it's very comprehensive slideshow presentation. And really thank you and your husband to put together this very thorough slideshow presentation to talk about your market. And it just cover all the issues. So any investors, they analyze your market. There's no stones unturned. So you cover everything. So with that in mind, right now, let's share my screen and go over a few more slides. And let's go over the all important, what we call it, pro forma, the cash flow analysis, right? So again, these numbers are mere projections. They are not precise, just like any other aspects of real estate. This is just a projection. Things may change, but still, it's important for us to take a high level. The final combination of our investors researching due diligence, they have to crunch the numbers to see how all the numbers works on this fourplex and relative to the benchmark. What I mean by benchmark is in the investment arena, we always pair a particular pro forma relative to the benchmark on a comparison basis. And the benchmark is, but technically speaking, we use like rent to value ratio, capitalization rate, cash on cash return, debt coverage ratio, total ROI. But we're not going to go too much in depth about it. That's another video, another presentation between you and I in the future. But let's take a high level. Let's analyze the your product. Let's analyze your quad that you're presenting on this video. So with that in mind, so here's I took the liberty of crunching the numbers on my property tracker software, propertytracker.com. Anyway, so your property is $535K. So our investor put a minimal 25% down payment, which is a requirement per the Fannie Mae lending guidelines, 1 to 4 unit. We are able to do investor residential lending, which is the most favorable product to use, 30-year fixed rate mortgage. And that is an amazing mortgage product, needless to say. So at 25% down payment on this fourplex new construction, 535K here in South Texas, equals approximately, if you include all the other fees, around $148,000 down payment. All right. And then using this current, I know the mortgage interest rate our investor obtain, based on different variables. Some people want to buy down the points to get a lower interest rate, but I'm using the assumption of this mortgage interest rate for this fourplex purchase at an arbitrary 7.3%, which is without any kind of buy down. Of course, when an investor or contemplating buy this fourplex, they will choose a loan options which they feel comfortable. Some people want to buy down the points to get a lower rate, but this 7.3% is assuming they're using a straight out investor loan rate, maybe a little bit of buy down. I'm not sure, but yeah, again, 7.3%, which is coincide with your current mortgage rate environment. We all know how challenging that is, but you and I should agree, because you and I have been in this investment game for a very long time, that when an investor buy investment property, the interest rate in a way are not that important, because the interest rate and the mortgage payment are only part of the cash flow analysis. It's a part of the debt obligation monthly, if you will. If everything, other metrics, numerical metrics make sense, as in this case, then it's a good purchase, because I use this term, date the mortgage interest rate, but marry the multi-unit. You like that?
I like that.
Because as an investor, we have the ability to pivot. We have the ability to negotiate our investment property over time, and everything is negotiable. Everything can be changed. Investor, we're different. Primary home buyers are very limited, right, in their strategy. Being an investor and being a primary home buyer are extremely different. It's the difference between night and day. Investors look at the numbers. They look at the cash flow, and so forth and so on, not just the mortgage rate. So let's go through the numbers, right? And the gross rent, I put a projection of gross rate of $5,400. So per door is like $1,325, $1,350, based on the potentially increasing rental rates that you and I discussed. So all four doors, total 5,400 gross monthly rent minus a little bit of vacancy factor here, which is right here, 4% vacancy factor, real estate appreciation projection in your market, let's say around 5%, and the property management fee is 8%. And so therefore your gross rent 5,400 and your property taxes, which is $750 per month, which is $9,000 per year. These are less than 2% property tax rate. So that's not too bad in terms of Texas, relatively speaking. So this is a very achievable. Is nothing, I don't see any kind of red flag. Property tax rate is a little bit higher in Texas than in other markets, but you offset that with you get no state income taxes if you are a resident of Texas. So that's that's an offsetting scenario. Plus, the property tax here is part of the monthly expenses anyway. It's part of the debt obligations that any investor will look into when they own a rental property. So insurance pretty reasonable, $183 per month. Property management fee $415. So then you have the total debt obligations down here. Then based on 7.3% mortgage, 30-year fixed rate interest, the monthly mortgage is, I can't even see, $2,000 something dollars. At the end of the day, 5,400 gross monthly rent minus the all your debt obligations, including the mortgage payment, equals monthly net cash flow was a little bit more than $1,000. So we're talking per door, per unit, out of the 4 unit, you get a monthly net cash flow per unit around $250. Multiplied by 4 doors, 4 units, equals monthly net cash flow at a little bit more than $1,000. As we stated, in the next few years, we don't know the future of the mortgage interest rate. No one have a crystal ball, but most experts agree that the interest rate will come down. We just don't know when. So again, this 7.3 mortgage interest rate, you take the interest, but you marry the multi-unit, so you can have the potential to cash out refinance. Once the mortgage rate come down to 6.5% to 6% for investor, then if you cash out refinance based on a future 6% interest rate from the 7.3%, you and I will probably agree that this monthly cash flow, which is a starting point right now of $1,000, could be $1,200, $1,300, or even slightly more, especially when you have a projection of a rental rate increase around 5%. So do you agree so far?
Yes.
Yeah. And finally, up in the upper right-hand corner, I know we're not going to spend enough time to go over the numerical formulas, but any savvy real estate investors don't understand what I'm talking about. But newbie investors, they may need time to digest what we can talk about. But up in the upper right-hand corner is 1% rent to value ratio. The 1% rule, which have been around for a very long time. In the past years, early in a decade, the 1% rule applies to investment property. The 1% rule means if you buy a property for $100,000, for example, a rental property, if you multiply by 1%, that means your monthly gross rent is $1,000. This kind of a metric is very positive. It tells someone that the positive cash flow is very high. But having said that, based on the last few years of skyrocketing housing prices and the elevated mortgage rate, the 1% rule usually are out the window. There's unrealistic expectations. Now, having said that, Janet, because as a real estate investor, as a real estate coach that I am, I take my investors to buy in many different markets in the U.S. for the past 20 years, turnkey, out-of-state properties. And the 1% rule has applied for many years until recently. The 1% rule still makes sense in the Midwest, right? When you buy investment property in the Midwest, the prices are very cheap. They're much older. It's a cash flow market. And the 1% rule still applies today. You can still buy in the Midwest a much older property in a middle class or lower class neighborhood in the Midwest, which covers a lot of areas, right? So you could buy a $100,000 property with 1% rule, you get $1,000 monthly rent. Bang, just like that. It's a very attractive cash flow. It's on a cash flow market. But to see a 1% rule applied to your market in Texas, in a new construction, on a fourplex for that matter, is extremely rare. And I have done a lot of research, not just recently, but over time on all the markets in the US. You're not going to find a new construction, especially a fourplex, in a fast-moving market, in the appreciation and cash flow market, or hybrid market, such as in Texas, where you get the 1% rule on your product. 535K, fourplex new construction at 1%, right? Which is 5,400 in your case. That is absolutely not happening anywhere in the country as of right now. Let me give you another comparison, Janet. Okay, a fourplex up the road 3 hours to the north of your market in San Antonio, for example, a fourplex at 4,000 square foot. In fact, let's share the screen. Let's talk like this. A fourplex new construction in 3 hours to the north in San Antonio at 4,000 square foot it'll cost you anywhere from 900,000 to $1 million, and the rent per door is only like 1,500, 1,600.
I know.
So if you do an apple to apple comparison, the cap rate here down here in South Texas, here in the McAllen Metro, Hidalgo County, in your market, it is mind-boggling. And by the way, in other part of the country, any kind of very good new construction fourplexes have been built. It's hard to build for any builder to build a fourplex new construction, let alone the price that we're getting here, 535K. A fourplex new built at 4,000 square foot in Los Angeles will cost you like $2 million. And the rent is only $10,000 per month, which is give you a cap rate of 5%. If you buy if you can find a new construction fourplex, let's say in Florida, which I'm promoting in Florida too, a fourplex similar square footage, your product is probably around 800,000. And the rent is, they're not going to meet the 1% rule. And the rent is 800,000. Their rent is probably total of 6,500 on all four doors. So their cap rate is a lot lower on new construction, comparably speaking, with your product. And of course, you can't compare a Midwest fourplex because you're not going to find new construction fourplex in the Midwest. You can only find, Midwest is not an apple-to-apple comparison because it's a casual market and you're not going to get the appreciation potentially you can get down here in Texas. So I'm not even going to compare. Yeah, you can find for 1% row in the Midwest on a much older property, C-class neighborhood, whatever, which is pure. A lot of people still does that because the prices are so cheap in that area. But we're talking robust market in your market, which your market is similar to the Sun Belt, right? Sun Belt market, which is the warm weather markets, fastest growing markets in the country, Texas and Florida and a few other states. If you compare to any new construction fourplex, 4,000 square foot into Utah or Phoenix or Las Vegas, their prices are $1 million and their rent is low. The cap rate, like 4% cap rate in those markets. So really no comparison. And you and I mentioned why when I venture into your market in South Texas, how come the new construction is only cost $535,000? Is it too good to be true? And rent is $1,250, $1,350. It meets the 1% rule in a Texas market, fast-growing markets such as your market. And your answer to me was that the cost of land is cheaper, at least right now here in South Texas. Therefore, the builder are able to take advantage of the low development costs, buying the raw land to build the fourplexes for investors such as us. So right now, the timing could not be better. Who's to say that the land cost is not going to increase for the foreseeable future in your market? You have to believe it's going to increase.
It's happening already. Yeah.
Yeah, exactly.
And it's going up. Yeah.
I have no doubt this is the early phase of growth in your market. So we already discussed that. Let's get back to the pro forma. All right. Yeah, the pro forma at the upper hand corner. So just to summarize this amazing pro forma cash flow analysis, upper right hand corner, as you can see, the rent to value ratio which is 1%, which is, to me as an investor for a long time, and I have taken my investors for the past 20 years to buy hundreds and hundreds of properties out of state. The rent to value ratios are 1%. This is mind-boggling, such a value add product in your particular market. And the capitalization rate, as you can see in the upper right-hand corners, 8.4% cap rate. This is mind-boggling. Our usual cap rate on a fourplex is by anywhere in the country is only by 4% cap rate, half as low. And cash on cash return on your fourplex product is cash on cash return. This is also very good. And the total return on investment is 29%, which is double, triple digit, just the first year. All right. So let's continue on. So this is pretty much the end of the pro forma. But wait, there's more. Let's dive deeper. We just went over just the first year projection, Janet. The first year projection is very attractive, even with the low, higher than usual 7.3% projected mortgage interest rate for the investor to finance his property. There's more. But you look at the gross annual rent, gross rate before deduction, first year, $5,400 multiplied by 12 months. Yes, $64,000. But we have to project 5% rental rate increase. Why? Because rental rate increase with the cost of living. The rental rate increase based on inflation, or inflation is at least 5 to 10% right now as we speak, right? So the gross rent, you can see from year 1 to year 10, you see a systematic gross rent increases. So your cash flow and your passive income from the multiple streams of income from 4 doors, from 4 tenants, you have 4 tenants, you can potentially increase the rent over time. So your cash flow can increase over time, year to year, hopefully. No one can predict the future. And then your passive income will increase accordingly. But, at the end of the day, we all want passive income to achieve our retirement. So if you project long-term investment, which this is the case, we're promoting buy and hold long-term, you and I, right? This is our investment methodology. So as you can see, the gross rent will increase. And then you look at the debt obligations, they will increase a little bit. The expenses on the management of the property, nothing else. Then look at something else. Look at the second page, the second slide. Then, then here's the minus the vacancy. Here's the net operating income. Because you're doing an amazing 30-year fixed rate mortgage, which I call it the 8th wonder of the world. The 30-year fixed rate. The 30-year fixed rate mortgage, no other country in the world have this type of amazing loan product, right? It's the capstone, it's a blueprint for financial freedom. Leveraging your debt through an amazing 30-year fixed rate mortgage will stay. Your mortgage will not increase in light of everything rising in cost. Inflation will destroy your wealth, but not rental property, not real estate. Your mortgage, inflation is your friend. Is a inflation. Another definition for me on a mortgage for an investment property is a inflation-induced debt destruction. This is a term came up by another person, not me. His name is Jason Hartman, in case you want to know. He called it the 30-year fixed rate mortgage for investment property is an inflation-induced debt destruction. So when people out there hear my word from this video, go ahead and come up to your own conclusion of what I mean by that. I'm not going to go into that. Cash flow, as I indicated earlier, will continue to increase, hopefully, over time based on historical comparisons. Then each time the renter will pay down your mortgage, you get some kind of benefit in terms of principal reduction, yes, be it ever so slightly on an annual basis. And then, of course, based on the projected 5% appreciation rate and your property, your investment property will compound. The magic of compound interest is another 8th wonder of the world. So based on 5% appreciation, you will see the systematic appreciation associated with earning this rental property. And then, of course, cap rate will continue to increase over time. And then here's a real nice thing. Based on a mere 5% appreciation, which on a year to year, which is based on historical past performances, long term on a real estate. You see the market value, we buying at a benchmark at $535K. A year later at 5% appreciation. At the end of the first year is $561. So based on 5% appreciation, yes, you can see the market value of this property continue to increase over time. I know there's some dips every now and then. There may be some correction that will occur from time to time over a long-term perspective. We're not going to get into that. But another great thing about it is your 25% down payment is your leverage to buy this fourplex. But the beauty of owning a rental property, you and I, Janet, we've been in this game for a very long time. Investor, they're going to outsource someone by the name of tenant. In this case, 4 tenants, they're going to pay your mortgage for you. Not only the 4 tenants going to pay your mortgage for you, going to pay down your mortgage over time, but your 4 tenants going to pay your monthly property taxes. Your 4 tenants in this fourplex going to pay down your property monthly insurance. Your tenants going to pay down your property management fee and the vacancies and upkeeps and maintenance. At the end of the day, you're still going to get monthly positive cash flow. So let your renter make you rich. All right, multiple streams of income from 4 doors. Janet, this is getting good, isn't it? This is a double benefit. So therefore, over time, your market value of your fourplex increase by these numbers accordingly. Compound growth of equity appreciation based on 5%, could be more, could be less in any given year. We don't know the future. But anyway, but your loan balance gets decreased over time, right? It's the amortization of your 30-year fixed rate mortgage. So your loan balance going to get decreased time, and your appreciation of your property increase from a historical point of view. Then you have market value from year over year minus decreasing loan balance year over year equals, that means your equity will continue to rise. You see the rising of equity from $164K at the end of the first year to systematically more at the end of the 5th year. The equity can rise more than $300,000 of pure equity. Value minus loan balance equals net equity. Then this LTV, loan to value ratio, loan underwriting is such that once you meet the 70% LTV, loan to value ratio, you can qualify to refinance your loan, to tap into the equity out to do what? Buy more rental property. So therefore, now this is one of the exit strategies that investors can do if they want to. There are multiple exit strategies available for investor over time. But this kind of software allow an investor for the next 2nd, 3rd, 4th, 5th year based on their investment goals and objectives to determine whether they want to cash out refinance. They don't have to, they don't want to. So every investor have the ability to make decisions that fit their goals and objectives. But given these metrics, they could refinance at any time in the next 10 years, right? When you do a cash out refinance, guess what? It's tax-free. When you borrow against the equity of your investment property, it's a tax-free event. So real estate investing gives you multiple layers of benefits, and tax benefits is one of them. Of course, you and I are not a licensed tax advisor. Consult your own tax advisor to go over your unique tax situation. But this is just an educational video, by the way. So this is the potential cash out refinance. Look at this. You are able to clearly see if you were to cash out refinance, how much money you can get out of it. If you want to cash out refinance at the end of the 4th year, you have 71 grand. Okay, you have 71 grand to do. So can you buy another single family home rental or duplex at the year 4? Of course you can. So that's how you scale your real estate portfolio. If you want to scale your portfolio, you do a potential cash out refinance. Now, one going to ask you and I, for example, Seewing, if you and Janet, if you cash out refinance, your mortgage payment is going to be higher because you have to pay a higher loan amount. Yes, that's true. I'm not going to get into the calculation of it, but yes, once you cash out refinance, for example, this $71,000, for example, your mortgage payment will be higher than originally what you pay on your monthly mortgage payment. But by the 4th year, your rental rates have already increased at the tune of 5%, whatever. So you have more cash flow, right? And also you can increase your rent from year to year, theoretically speaking. So you still have enough positive cash flow available from your property to absorb the higher mortgage payment as a result of the cash out refinance to leverage into buying additional rental property at some point in time in the future. Am I right or wrong, Janet?
Correct.
Okay. All right.
Absolutely.
As we conclude this, of course, just to review your beautiful, high quality construction of your quad fourplex in McAllen Metro, South Texas. I'll quickly go over this because you already gone over this on our earlier slideshow. So I'll do this real quickly. Then we'll come back to our main screen momentarily. All right. It's a beautiful property. Again, let's take a step back, Janet. The way I would teach my investor, take the big picture. Rental property. I love 1 to 4 unit, single family home, duplex, triplex, and fourplex. You know why? You and I love that, right? Because we're still getting that one loan on this 4 unit. We're still getting a Fannie Mae loan, which is the most attractive lending guideline out there. Am I right or wrong?
That's correct.
That's right. So rental property, as in this case of your product, fourplex, is, let's take a big picture. Let's take a step back and to digest what does it mean to become an owner of at least one or more of a rental property. The rental property, in my philosophical definition, is history's most powerful and proven multi-dimensional real estate asset class. It's the world's greatest wealth building investment vehicle. You get cash flow, positive cash flow right from day one, and then you could increase your rent to get more passive income due to an inflationary environment. At the end of the day, sometime in the next 10, 15, 20 years, your passive income from each of your rental property should achieve your definition of financial freedom. So far, so good, Janet? Yeah. And tax benefit, I'm not going to go into it. Every investor have their own unique tax situation. Consult your own licensed tax advisor. But your tax benefit will give you paper loss depreciation. It'll reduce your income subject to taxation. Again, it depends who qualifies and what have you. Passive losses, depreciation, paper loss, cost segregation. You can accelerate your depreciation of your properties. You can become a real estate professional tax status. You can do a tax-free cash out refinance, like we talked about. You can do a 1031 tax deferred exchange. We're not going to talk about something that's available for some people. And over time, the beauty of investing over time, long term, is appreciation and equity growth we talked about. And finally, the power of leverage, the power of using a 30-year fixed rate mortgage to leverage, your investments. You put in just a 1/4 of the risk of a property and let the whole property appreciate, even though you put in such a low amount of down payment, 25%, and fixed rate mortgage, which is like I said, like Albert Einstein said, the power of the compound interest, the power of a 30-year fixed rate mortgage is the 8th wonder of the world. And finally, the great legendary investor Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. Whole bunch of people out there are very fearful for no rational reasons. We're not going to go into that, but that's good because we, as a capitalist that we are, you and I and our investors, capitalize on other people's fear. Be greedy in a good way. Be greedy means pounce on the opportunities. In times of crisis, there's a whole bunch of opportunities. And right now in your market, your fourplex is a value add. We couldn't be a good time, better timing to pounce, be greedy, to take advantage of this low cost for right now, your great fourplex, high cash flow, 1% rule, meeting all that stuff. And while everybody is scared. So therefore, you get less competition right now. Guess what? You know why? Another reason to buy now, because you lock in the current price of your property. You lock in the 30-year fixed rate mortgage based on the environment of high interest rate. Janet, guess what? By getting in without much competition right now, and right now, nationwide, we have a historical low inventory supply, and we still have a pent up demand, even at an elevated mortgage rate. Today, we have this scenario, economics 101. What does it mean when there is still a currently pent up demand based on historically low supply of inventory? Economics 101, you tell me, what does this mean?
Yeah, housing's needed desperately everywhere. And when people are flocking to an area, it's all about timing, right? With our investments as far as they're going to climb. I took the big capital investors are starting to come down from Dallas, right? And they used to do value add, just the older 300 units, go fix them up. And now they are finding that our complexes are value add for them because brand new, they don't have all the expenses that they had. And so the brand new is lasting longer. So they're calling our brand new value add, which normally you didn't do that. But there's no expenses the first year because you have the warranty. And it takes 5 to even 10 years to start to feel any expenses. It's all about timing. I really don't know where it'll go in our area, but it can't help but go up, up. And these prices, they can't last. So it's a great time to lock in the price. And I'm not just saying this, I'm buying. I own here. I have a development I just finished last year in Tallahassee in Florida. I'm big on Florida. I've sold everything I have everywhere else and I've put it in South Texas. That's how confident I am in what's going on all around me.
Yep. Janet, you practice what you preach. So that resonate well with their prospective out-of-state investors from our network as well, among others. Oh, by the way, guess what happened? Smart investors, they buy now, lock in to this kind of fourplexes. What happened in the future? We don't know when the mortgage rate, if and when the mortgage rate decreased to 6% or 5.5%, what's going to happen at that time?
Prices are going to go up. And land is already, that's the biggest gripe my developers have, is land is already so expensive because people see what's going on and the people that own the land. So that is holding them back from doing a lot more building because people are asking solid gold for some of the land. So they have to buy carefully.
Janet, you're absolutely right. Because when the mortgage rate changes in the next, who knows, in the next 6 months, 12 months, 18 months from now, and a lot of housing experts are predicting the mortgage rate may come down to 6%, maybe even slightly less than 6%. What's going to happen? All the other folks right now who's sitting on the sideline, who is on the fence, waiting for the perfect time to buy, when the perfect time to buy at 6% mortgage rate, it could be a housing frenzy. There will be the blind leading the blind, and then a whole bunch of investors going to flood back into the market, chasing each other, overbidding and competing against limited inventory in the future. And the houses will increase dramatically. We're going to see bidding war. We're going to see multiple offers all over again. Nothing can come closer to 2021 because 2021, we have 3% mortgage rate. We're not going to do that again, right? That's not going to happen again, but it will have some kind of resemblance. So smart investors, they buy when there are less competition right now, right? And then when you lock in this low price right now, low land costs in your market, low development costs, all the low costs are transferred into the investors when they buy right now. You lock in the price at 535K. There's no way this fourplex gonna be stay at this price. I just can't see it based on the trends and the metrics that you and I just discussed very clearly in your market. It's all about timing. Timing is all about time in the market, not timing the market. Smart investor, you and I, we agree that you have to take the contrarian approach, right? When everybody is fearful, that's when we become a capitalist. You become greedy in a good way. What else have we not covered? Let's recap again, given your market. So you're working with 7 builders, which is amazing. You could have upcoming product, multi-units coming up, brand new construction, which is amazing. So the recap is your rental market is very strong. There's a shortage of rental units available in your market. So you can see an abundance of renters that are gonna rent this kind of fourplexes. No problem with that. A very little problem. Easy to rent, quickly to rent. You have a great property management, several property management. So you have a one-stop shop in your market, and you're the broker. You oversees everything. When an investor come to you, you do everything turnkey, short-term, long-term. Your property management can help them manage the properties over many years. You can be involved. You will oversee that our investors, that the property they're buying, that they're going to do well over time, do everything for them. So did I miss anything on this presentation?
I don't think so. I think you're very thorough. I get excited listening to you about my market. Makes me want to buy more.
Absolutely.
Yeah.
Absolutely. Yeah, that's right. Yeah, so I think that's pretty much it. I think I covered all the deals, but your fourplex are selling quite consistently. There are more investor buyers that want this kind of value add fourplex that you're promoting than there are available inventory. Even though your builders are ramping up in constructing more new builds down the road in a near term, but you am I to believe that your market is heating up, that more and more investors are discovering your market, even though your South Texas market or uh, I think it's really is a little bit under the radar. The mainstream media on really have not caught up to it. But that's a good thing right now, right? We get in before become too pop, get into the mainstream because when the mainstream knows about this market, when the other sideline investors, when they're ready to do it in the future, it's going to be too late for them because they'd be competing against those people or on the fence right now, sitting on the sideline waiting for the perfect opportunity, which is no such thing as a perfect opportunity. So tell me, is that how it is in your market? You see the demand is greater than your supply of your quads and all that?
Yeah, get calls all the time, and it seems like the majority of them are coming from the Big Four. So we're finding Texans are finding our area, and they are priced out in their own marketplace in the Big Four, and they're coming down, and they see the value here. As far as nationwide, it's not like we don't have California investors. I'm from California, so I've drawn them to us. But no, the big word is not out there, which is amazing. I can see that we're on the cusp of with what's going on with the freeways and all the new companies coming in. Some people miss it. They wait for all that to happen. And then you're up at 800,000 a fourplex. Right now, we're right at the bottom level of all that happening. Companies being built, infrastructure is going crazy. And I don't know if you guys know this, but South Padre Island, it's about an hour away and it is beautiful sandy beaches. And a lot of our builders have investment homes out there that are beachfront. And it's a great hop, skip, and a jump for people to go to. So there's so much going on.
Oh, what did we forgot? I think Elon Musk, he has a rocket launching platform very close by to your area. Is that true?
So SpaceX is in Brownsville. It's 45 minutes. And not only did they open SpaceX there, but he has given millions to Brownsville is a small town, right? So he's given millions to the city to revamp it. So it's this cute little town so he can get his employees to love living there. And because he's done that, other companies, aerospace companies, are popping up all around him. Brownsville is going crazy because they can pull in. It's also a port. Just so much going on from every level.
Janet, let me recap for you. Okay, I know
Okay. You go.
there's so much to recap.
Yeah.
Here's the deal. South Texas, for investors that will continue to do their due diligence and research, I get that, you get that. But you have a very diversified economy. You have logistical, you have transportation, you have manufacturing, you have high tech is up and coming as well. And doing business with Mexico across the border, you can only enhance your employment base and everything else. And on top of that, another metric I look for when I enter an emerging market, I look at the medical industry. You guys have very robust medical hospitals and clinics and training hospitals, and college and University of Texas have a campus here in your market. University of Texas at what they call Rio Grande, they call it Rio Grande. It's just a huge campus. University of Texas, this system is, I believe it's the largest university system in the country. Am I right or wrong?
It is. It is.
There are a whole bunch of smaller colleges and universities and trade schools located in your metro. They'll bring more jobs, more millennials, more young workers into staying in South Texas to help South Texas grow. Then you have retirees that like South Padre Island is only 1 hour. I knew that. South Padre Island, yeah, is only 1 hour away to the east. A hop, skip, and a jump. And then high upper end shopping malls and major grocery chains and all these metrics. That's how I do it. That's how I analyze a particular emerging market. My recap is pretty much done. So go ahead and you do your final recap in terms of action plan call to action for my investors. So what's the urgency and the involved? What's the critical next step investors to take advantage of your market before it will go crazy?
The play is when my builders are not quite done yet to put them in contract. Because once they get complete and they're putting tenants in there, they go so fast. So the ones that are 2, 3, 4 months out, that's the time to grab them. I have about 3 other communities where we have some coming up. So that's the play there. For your bigger investors, I also have a couple of bigger things coming up that are brand new, 18 units and things like that. So if that's something that your bigger investors would like, when I talk to them, I can evaluate what their needs are and I will find it because my 7 builders give me access to whatever I need. I call them, they all know each other. They interact. We have those 10 and they are in multi levels of being finished. And so now's the time to put those under contract.
Great to hear. Thank you so much.
It's a pleasure.
We can talk all day. We can talk all benefits, time limitation. We will do some future videos, follow up for our investors. So you can tell my excitement. You can tell my passion because I don't take in a new market for no reason. I do my own unique research and due diligence and have done my research and due diligence in your market for the past several years. That's why we are partnering with you and your team, one-stop shop in your market. Property management, the whole 9 yards, buying remotely, buying passively, buying successfully for RSA investors. It works well in your system, in your market. So we are my network and your organization in alignment, in the right fit for our investors mostly from California. So looking forward to working with you. And with that in mind, thank you for taking your time to thoroughly explain the unique aspects of your market. So this is greatest time to buy right now in times of a crisis, and be a contrarian investor. My investor, any investor out there, be a contrarian. Where everybody run one way, you go the opposite way. That's how you make money time and time over again for decades in the past, and it's no different right now. So thank you and for attending, Janet Clement. Thank you so much. And everyone out there, we'll see you on the other side. This is Seewing Yi. Have a nice day. Good luck. Bye-bye.